We're looking at the 200-day moving average, which is at about 5,100 points as a major level of support. If we do see that area being broken, then it would spell a more technical selling coming in. But for the time being, we are hoping that that support level will hold. It was a flat day on the market, some large volumes, and about 10% of those volumes due to QBE Insurance. It was the most traded stocks, about $440 million worth of stock being traded in that stock, and a range between $10.53 all the way up to $11.57. We did see QBE reaching the lowest level of the year so far. And if we have a look at QBE Insurance shares down by about 10%. There was also more bad news on the market. We actually saw Qantas shares reaching an all-time record low of 95.25 cents, and also a year low for both Incitec Pivot and Troy Resources. But it wasn't just bad news on the market today. We did see an upgrade from Dexus, although its stock did close flat, and we saw a record debut, which was quite good. But I guess the reason why the market closed flat was because of the materials and the banking space, both which ended the day flat. The materials space, it's understandable because right at this moment we should be seeing numbers dropping from China. Industrial production, which is expected at 10.1%, retail sales, which is expected at 13.1%, and fixed asset investment, which is expected at 20%. So these numbers for the month of November, the market would be watching them very closely, especially after that trade surplus, which was the biggest trade surplus that we've seen in almost 5 years. So just watching those China numbers to give us a gauge of how commodities may trade tonight and also on the Australian market.
Justified, do you think, or is some of it overdone? Because it's certainly been extreme. And as you mentioned, the volumes have been very heavy.
I think your view on QBE has to evaluate whether the conditions that we're seeing now will last forever, which the market's pricing in, or whether it's a temporary condition, whether we'll see 1 or 2 years worth of pain and then we'll see a bit of a turnaround. And my viewpoint is that it's the second scenario. I mean, both Suncorp Metway and Insurance Australia Group are both stocks in this space which have also seen a lot of pain, and we've seen significant turnaround, we've seen significant upside for the share price in the last few years. I mean, if we have a look at QBE Insurance and have a look at what caused the extra sell-off today, we saw a raft of broker downgrades coming through. The lowest one was BBY with an $11 12-month target and an underperform, and the highest 12-month target I've seen has been from Nomura, which has a $14.50 target and a buy, but the average of about 8 brokers which came out today stands at $12.93. I think one of the concerns that the market has are the gearing levels, which should hit above 40% by the end of the year, and that's of course outside of QBE's target range, but that should fall back to about 41% by the end of June. And with the $500 million convertible debt raising, I really don't think a capital raising is on the cards here. If we have a look at QBE Insurance, just another thing to point out, this is actually a 10-year chart for QBE Insurance. You'll notice that when the downturn started, that's also when interest rates were falling here in Australia. And really what we're seeing with QBE Insurance is 2 macro factors which are moving in QBE Insurance's favour. One are the interest rates over in the US. For every 1% interest rate move, we actually see a pre-tax benefit of about $480 million for QBE Insurance. And of course, the other is the currency moves. And as we see the Australian dollar depreciate, that's good news for QBE Insurance. So we did see more selling on the back of those broker downgrades. And I guess for investors, they really have to evaluate whether these conditions are going to last forever or whether we are going to see a turnaround after 1 year, 18 months.
So, Julia, that was one of the bottom performers. One of the top performers, Billabong, had an AGM, the Gold Coast, earlier today. Clearly, the market liked what they had to say about 7-point plans, refinancing deals. Their shares closing up 18.5%.
I mean, this is a good demonstration that even the worst conditions don't always last forever, and once the bad news is factored in and there is some good news that comes through, we can see some positive share price movements. Billabong up a massive 18.5%, and often things that move a share price is new information. This can be things like new management, new strategy, new product or a new service, and in the case of Billabong, it's a new strategy that they've outlined today. Now, they have outlined a 7-point turnaround plan, and this of course comes after their last year's loss of $860 million. They are looking at revitalising their brands, no new ideas here, but they are also looking at building new channels, going directly to the customer, aiming to get about 30% of sales from that avenue over the next 5 years. They'll also be restructuring the supply chain, a lot of their supply coming out of China at the moment, but they're looking to diversify that. And if you have a look at some of the other retailers, we know that a lot of the supply now comes out of places like Vietnam as well as Indonesia, depending on where the exchange rate is the most favourable. So they'll be restructuring that and, of course, funding a war chest, a massive marketing war chest. To do that, they'll need to cut costs as well as improve profits. But I think the fact that there is a plan clearly now in place, investors saying that the bad news is probably behind Billabong and the shares jumping by 18.5%.